My guess is when you started the new year, you thought the hardest thing you were going to have to deal with was keeping your New Year's resolution. Well, the market has other ideas. We've hit a rough patch, and we're going to talk about it in this month's market update. It's January. We're at the end of January, and it's no secret you're probably watching this right now thinking, what's going on with markets and why are things so haywire here? And we will get into that in a moment. But we can never have a discussion in January without talking a little bit about taxes. Now, for some of you, it might be premature to be worried about taxes when we're in January and the tax deadline's in April. But right now is when you start gathering all of the information that you need to provide for your tax preparer, whether it's an EA, CPA, bookkeeper, whoever it is doing your taxes, even if you're doing your own. You need all of those things like 1098s and a W-2. Well, from us, if you're a client of ours, or if you're working with any financial advisor, most likely, you're looking out for a couple of tax forms, a 1099, a consolidated 1099, and a 1099-R, which tells you what kind of distributions you may have taken from a retirement account. So we have those forms coming out very soon. Take a look here. This is a breakdown of what you can expect, the dates that you can expect to receive some of the 1099s coming from our office. And as you can see, the first 1099s are going to be sent out on the week of January 31st. That's a 1099-R and a 1099-Q. Also in January, late January here, you can expect we will begin mailing the consolidated 1099 tax statements for the simplest accounts and the simplest tax information coming from the accounts. And then accounts with more complex issues will be rolling out the 1099s on the week of February 4th, 11th, 18th, and 25th. And then you can access all of these forms, whether it's the 1099 forms or you'll see even later in February, there will be the form 5498, which is the forms for making contributions to your retirement accounts for the last tax year. All of those are going to be available online. So I'll take this opportunity as well to say, keep an eye out on the mail or in your email if you've gone paperless for these tax forms. But I would also encourage you to sign up for AccountView. AccountView is a fantastic resource. It is our website access to your accounts, your statements, and your tax information. And we have an app as well, the LPL AccountView app. That app gives you access to all of this on the go. And so you can log in on your tablet, your smartphone, or whatever else device you use to access your accounts. You can just click on the app and get your tax information there. It's easy to download and forward to your tax preparer. Okay, so with the tax stuff out of the way, let's get to the nitty gritty. Why is the market going so haywire? And we are in correction territory for a couple of the indices that we track. Mega cap tech, the big tech names that you know, are having a heck of a time. And it's really easy to think that this volatility that we're experiencing right now is extreme. Why is that? Well, it's been a while since we've had meaningful volatility. In fact, the S&P 500 on average drops 5% 3 times a year and drops 10% or more once a year. Well, in 2021, we only had one 5% drop, and that was during that China Evergrande, I'm going to call it a fiasco, right? Because it wasn't exactly a crisis. But prior to that, we hadn't had a meaningful dip since a year earlier in late 2020, and then of course we had that huge drop when COVID hit, and we were going to flatten the curve for 2 weeks in February and March of 2020. So in between there, we've had tremendous government stimulus, a lot of help from the Federal Reserve, and as a result, it's been pretty smooth sailing higher for the last few months. And so it's no surprise that we're really probably getting back to more normal volatility, where we can expect a lot of 2 steps forward, 1 step back, this kind of 5% dip every once in a while this year, and maybe even a larger one like we're getting now, at least once, perhaps twice. But it's easy to say, well, we have volatility. Why the volatility? We can look at a host of things. We have rising inflation that's stickier than I think some people expected. The Federal Reserve is getting a lot of blame, where there's a lot of focus on what's going on with interest rates. Are interest rates moving higher? They most certainly will be, and the Federal Reserve has said as much. But the question has now become, how far, how fast will interest rates go to try and kind of beat back this inflation issue that we may have? You can layer on the issue going on with Russia and Ukraine and other geopolitical things. We're headed into a midterm election. You can kind of see here where you can choose your crisis almost to say what's going on. But I would say most immediately, A lot of the volatility that we're experiencing right now has to do with the Federal Reserve and investors kind of wringing their hands over what may happen and when we might get our first interest rate increases, whether it's going to be in March or June. And in March, is it going to be 0.25%? Is it going to be 0.5%? A lot of that is kind of weighing on investors right now as we recalibrate the values, particularly of large mega cap tech stocks. Here's the thing, though, to consider as we look at inflation and rising interest rates, and that it's that rising interest rates don't in and of themselves cause economic problems. In fact, a lot of the inflation that we have right now is kind of the exhaust coming off of the economic engine. So interest rates are going up because the economy is healthy and is doing well. And even if corporate profits right now and earnings reports are mediocre, we are still growing, and there are no signs right now of a recession of any type. And so that's one of the reasons why the Federal Reserve is talking about raising rates, is because we kind of have too much smoke coming off of the economic fire, and they need to address that before the problem truly gets out of hand. One thing to consider also is that markets have in the past gone up. The S&P 500, for example, has gone up early in the rate tightening cycle, right? When rates are starting to go up. It's not often, in fact, it's rarely a bad situation for stocks. It's only later down the road, once the economic conditions get really tight and interest rates get much higher, that it can create longer term problems for us. And so if we have learned anything from the tech wreck, from 2008 and the Great Recession, or even that 30% drop that we had in the first and second quarters of 2020 with COVID, it's that staying put is almost always the best option. We want to make sure that we have a full understanding of what your risk tolerance is before you begin investing, before we kind of start creating the recipe of your portfolio for you. Because in times like these, we don't want to cut and run. We don't want to get the jitters, because as all of those dips have shown us in the past, it's like fidgeting in quicksand. You're just going to make it worse for yourself when we're trying to adjust on the fly when markets are in correction territory. So consider that while you're thinking about your portfolio and what this market correction has to do with you and your plans for retirement. If you have questions about what's going on right now and how that affects you and your financial plan and your retirement plan, shoot us an email, info@fordfg.com. You can give our office a call as well. Or you can follow us on Facebook and follow us on YouTube and watch these market update videos regularly, where we'll address these things as we go deeper into 2022. Good luck with the market correction. Stay safe. I look forward to talking to you in the next one.